welcome to the FII View. I'm Tanveer Gill in the Mumbai News Center. My guest today on the show is Chris Palmer, Head of Global Emerging Markets at Henderson. Chris manages over $5 billion in emerging market assets. Chris, it's great to have you on the show. Thanks very much for taking out the time. My first question to you is about the fund flow situation that you're seeing across emerging markets. Are you seeing outflows from your emerging market dedicated funds? Are investors convinced about the U.S. recovery at this point?
Our global emerging market funds are experiencing flows which are about average for the industry during this last period of weakness. We've seen higher flows in the industry in indexed and ETF products, but for active managers, we feel the flows have been contained.
Right. Chris, did the non-farm payrolls data suggest that there's going to be more strong and sustainable positive economic data coming out of the U.S. in the near term, in lieu of course, what the Fed governor had to say recently?
I think one data series is not enough to convince any market participant that the U.S. economy is in a sustainable recovery. But there is evidence that employment conditions have improved. But the Fed is going to continue to look at other factors, such as house prices and mortgage applications, as well as a sign that households out there feel that the recovery is sustainable.
The big trade, Chris, that we've been following in emerging markets is what's happening with the currencies aside of the markets. How are you managing the currency risk for your EM funds or EM dedicated portfolios?
Well, we know from experience that when currencies fall in emerging markets, it's typically flow-related. Portfolio investors selling their emerging market investments and repatriating back to their home markets. We think that these flows and the currency-related flows have been largely related to fixed income investments in local currency, investments in local currency funds. What we have to be aware of when we manage our equity fund is which countries are likely to be the most susceptible, and try and come up with a strategy either by reducing our weight in that country, which is what we've done in some of the higher risk countries which are susceptible to these flows, but also thinking about weaker currencies can help some sectors, such as exporters. And raising our weights in exporters is another way that we can fight a trend of a weaker currency.
But do you see more downside risk to emerging market currencies from here?
I think EM currencies could see some more downside under one very specific scenario, and that's if the Fed taper comes sooner than expected, U.S. rates will rise sooner than expected. That will have additional pressure on EM currencies. The second is if the Japanese are very successful as well in reducing their currency as well. So if the Japanese currency is weakening and the U.S. dollar is strengthening, that leaves a lot of EM currencies between a rock and a hard place.
What would be the profile that emerging markets would kind of develop if the U.S. recovers? There is also talk of UK recovering amidst risks with growth revisions happening there as well. So, you know, how would this recovery really impact the profile of emerging markets?
Ultimately, we believe that a developed markets recovery is good for emerging markets. What we're going through right now is a transition phase where emerging markets, because of their higher growth rate for the last decade, were a favorite place for investors to put their money. Now the growth rates are looking more similar between emerging markets and developed markets. Emerging markets still have a higher growth rate, but that gap is narrowed. Now, over the next 12 to 24 months, what we're going to see is the effect of that better developed market growth rate begin to feed through to some of the traditional winners in emerging markets, those countries with good export potential and labor markets which are competitive. They will be the winners. So we're in a transition on a number of levels for emerging markets, with winners of the last decade might be giving way to winners of the next decade as the developed markets begin this recovery.
Well, if the US recovers, would you shift your focus to export-oriented companies or sectors in emerging markets, technology being a case in point, especially in India, from the large consumption story which is at play right now and where, there's a big debate between valuation and growth?
It's very clear from global trade patterns right now that trade is picking up between emerging markets and developed markets. The US economic recovery, for example, is creating quite a lot of demand for products from countries like Korea, Taiwan, Mexico. And in Europe, we're beginning to see better figures in trade for those countries which are trading with Europe. So I think it's a natural outcome that stock pickers start to look for trade-oriented companies, companies which want to be part of that global trade pattern and are looking outside of their home economy to take advantage of that uptick in growth. Remember, the US economy is still the world's largest economy, and if its demand for goods increases, that is very good for emerging markets. Europe, as a bloc, is the world's second largest economy, and that's improving also. And I think that's going to have profound impact on what types of companies do well in the course of the next decade in emerging markets.
Chris, you have a higher rating for Brazil, China, Russia in your emerging market fund. India is more of an underweight. Why is that the case?
Traditionally, we've been underweight India because of the very poor current account deficit situation in India. India's budget deficit also has placed huge strains on the current account, and India's had to finance these shortfalls increasingly with short-term investor money. Now, as we've seen money leave emerging markets, fixed income money leave emerging markets, India's not been immune to this. And what we've been seeing over the course of the last few months is a weaker and weaker currency for India. This is one of the key drivers to an underweight in domestic-oriented stocks, state-owned banks, a number of sectors. That, however, is changing, and we have an open mind towards looking at Indian companies which have a good export potential, who've been investing abroad in new technologies or capabilities, or where the decline in the rupee has made their workforce much more competitive. Examples of this would be IT is more competitive now with a weaker rupee, we believe. Many of the pharmaceutical companies in India are also more competitive with this level of rupee. And the other thing, of course, is that with the weak foreign exchange level, it's going to be much more difficult for companies to export to India because simply Indians aren't going to be able to afford those products. That's going to give a new lease on life to some of the Indian industrial companies, which have felt hard-pressed in the last decade by foreign entrants.
How do you view the risks coming out in China? Is it rising in this slowdown with talk of a credit bubble there?
China is an issue of paramount concern to all emerging market investors. Right now, there's quite a lot of concern in China simply about the quality of the data that the government's presenting to the markets. And in recent months, they've had to withdraw some data from the markets because the data was found to be inaccurate. This is the type of thing which gets investors concerned right from the outset. With regards to the credit situation in China, we've also seen a sharp spike in the Shanghai interbank rate market, which took investors by surprise. The government is tightening financial conditions in China simply to get a gauge and a measure of how bad their internal situation is. I think that gives you an idea that Chinese officials are concerned about credit conditions inside of China, and they'd like to get a better understanding of just how much non-bank financial lending there is out there and how vulnerable their system could be to a credit crunch. For the first time in a long time, some strategists are talking about this credit situation in China leading to a credit crunch. And that would be certainly a negative for emerging markets, but particularly those countries and those companies which were hoping to export to China.
So what will be your emerging market strategy in the wake of a U.S. recovery?
As the U.S. economy recovers, and later we start to see recovery in Europe and Japan, emerging market funds will benefit, we believe, by positioning themselves more towards exports. Technology exports are a good example of a sector that we're beginning to favor more in our funds. But also any company who's got the flexibility within their manufacturing or production to service both their domestic market and the international markets through export and trade. There are a number of emerging market companies which have this flexibility. Korean automobile manufacturers, for example, India's IT companies. All of these are good examples of companies which can shift their production, shift their resources to service more than one market. So certainly that's going to be a big feature of emerging markets going forward. You're also going to want to be in companies, and as our strategy changes with the markets, rising interest rates are going to become part of that story of the U.S. recovering and that Fed taper story. This is going to put additional strain on emerging market companies who've assumed that the bond market is always going to be there for them and that they're going to be able to afford the cost of borrowing from Wall Street. This is going to change as well, and we're spending quite a lot of time in our research making sure that the balance sheets of the companies that we're investing in can also withstand the strain of higher U.S. interest rates in the next few years.
What is the view on India? Does the market have more downside risk because we seem to be stuck in this broad range?
I think the Indian market is beginning to stabilize in the wake of the big drop in the currency in recent months. We are seeing renewed interest in export stocks and some investor interest in those shares. The big risk we see for India is that the stock market there is separated into really two kinds of companies. Those which have attracted a huge amount of foreign interest in the last few years. And that's a very short list of stocks. And that concentrated list of stocks, we believe, has got quite a lot of risk if there are outflows to emerging market funds. Interestingly, the rest of the Indian market doesn't appear to have those risks. It appears to be dominated by local investors, pension funds, insurance companies, mutual fund companies, who've by and large shied away from the stocks that concentrated group of foreign investors has piled into in the last few years. This creates some very interesting risk and reward possibilities for investing in India. The companies where the locals have been buying tend to be cheaper and tend to be a bit riskier. And that's probably where some more strength for the Indian stock market will evolve as that outflow story or foreign investor story perhaps becomes more volatile.
How much rests on politics as far as, FII outlook on India is concerned? Can a new government change the outlook that foreign investors have for India?
Foreign investors aren't particularly interested in which government is in power in India. It's what, of course, that government does that's important for us. Indian politics aside, foreign investors generally don't have a view about one group or another. What we'd like to see is more reform in India and perhaps more focus by government on the real fiscal limitations that India is going to be facing in the next decade, given the size of its budget deficit and its susceptibility to energy price fluctuations. These are two things that India really needs to address. And to us, it wouldn't matter what government was in power, as long as they had the right people and the right focus, and they can build a consensus around changing and reforming India in the right direction.
Is there a case, in your view, for the RBI to pause or perhaps even hike rates end of this year, or is there still some headroom for a rate cut? Do you even factor that in at all at this point?
Given the recent weakness in the currency and the impact that's going to have on imported energy prices, I do not see much of a possibility that India could be cutting rates anytime soon. The currency, if it continues in its pathway, will start to become a bit of a severe headwind, and that might actually call for an interest rate rise. We've seen it done in other countries, such as Indonesia and Brazil. So I wouldn't even put an interest rate rise completely out of the picture for India sometime in 2013.
Well, the big talking point is the rupee. So what's your view on the rupee versus other emerging market currencies?
Well, one of the key drivers of the currency market is investors' perception of the current account deficit. One of the ways in which India can control that current account deficit is to slow down economic growth and the importation of energy, which is politically very unpopular. So if things continue as they are in India, I think that you'll see the Indian currency continue to be at the weaker end of the spectrum of emerging market currencies.
Chris, the last time we spoke, you liked Tata Motors and Ashok Leyland in autos in India. Has the sector run its course, you think? Is there still potential there?
The Indian automobile industry, as a domestic demand play, should still see good growth rates for the next few years. However, those growth rates are going to moderate, and there is more competition in the domestic market. We have shifted our focus from the domestic automobile market to more export-oriented companies. Those in pharmaceuticals, for example, and also in IT are new focus areas for us. And also going with a simpler basic building block of domestic demand, which is focusing on the building materials market, which we think has bottomed in India.
With a recent gas price hike announcement that came by, there's been a changed view on Reliance Industries. The stock has gained considerably over the last 1 month. It's broken out of that 850 range that it was in. ONGC also seems to have found favor. Are you looking at these stocks favorably right now, or are you looking at the energy space favorably in India?
We are still struggling in a way to figure out exactly what the Indian government wants in terms of gas pricing. And companies like Reliance and ONGC, their fortunes are more or less tied up with the sentiment around what's the next thing the Indian government says about this issue.
India has also been touted as an infrastructure story. Would you avoid that sector completely, given the execution risks and the funding risks that there are?
Specific sectors we would avoid in India would be sectors where there's leverage ratios which are unsustainable, or assumptions about continued use of bank funding for leverage which are not sustainable given the condition of the state-owned banks. So capital-intensive industries, industries which are oriented towards fixed asset investment, highways, power plants, mining, any kind of large-scale infrastructure or natural resources investments which are only partially completed, particularly projects which need more money in the next few years. I think it's going to be very difficult for all of them to be successful. And only the projects that either have the best funding already arranged or have somehow managed to attract foreign capital into their projects because of the nature of the project lends itself to a foreign investor. I think these are the ones that are going to be okay, but we are worried generally about those large infrastructure projects, but also large manufacturing and natural resource projects in India, which are still incomplete. This is the worst time to be invested in a company which has not yet completed or is behind schedule on a large project.
So how do you map the investment cycle from here? Do you see investments picking up in the US, and will that have a domino effect, or will that actually trickle down into pick up in investments in emerging markets like India?
Well, we know from recent headlines that international companies are very interested in India. I think it remains a focal market for many consumer companies who they want access to the Indian consumer. There's no doubt about that. That's why the retailing laws were changed and reformed last year, and why drug companies and consumer products companies have tried to increase their ownership of their subsidiaries in India. So I think it's a foregone conclusion that U.S. companies will try to increase their footprint in India. However, they can only do this at a pace and in amounts of investment that are accommodated by basically the views and opinions of the Indian government. So the money's out there, and these companies we know want access to markets like India, but many other emerging markets. However, the Indian government has to step back and say, how much of this do we want to accommodate, and how welcoming are we going to be of this foreign investment?
All right, Chris, we leave it at that. Thanks very much for speaking with us and giving us your views on the global market environment. With that, we come to the end of this edition of the FII View. Thanks very much for watching.